Let's begin. So, good morning and welcome to a group discussion with the Lighthouse management team ahead of the release of their results for the 12 months to 31 December 2023. Just representing Lighthouse, we have Justin Muller, Kobus van Billion, and Razvan Sin. Please note, all guests are muted and the meeting is being recorded. If you'd like to ask a question, just use the chat box or raise your hand and I will unmute you. With that, I now hand over Justin, who will take us through some highlights or key points from the trading update, and then we will go to questions after. Thanks, Justin.
Yeah, thank you, Ridwan. Morning, everyone. Apologies for our fairly makeshift video conference setup. We're on the road currently. We're in Spain. Just found a meeting room to at least chat to you guys from. So thank you all for attending. I think I'll start by maybe giving an overview of the macroeconomic environment we're seeing. Inflation's come down quite nicely in Eurozone on end of November. The latest print was 2.4%, so getting very close to the ECB's target band of 2%. The back of this, we've seen bond rates come down quite nicely. Interest rates also recovered. We always reference the 5-year Euribor when doing property transactions because most of our loans are 5 years. Those rates used to peak at around 3.5% during the course of this year, and it's now around 2.8%. So new base rates at this kind of point in time on 5-year funding is around 2.8. It does make acquisitions a bit more attractive. At least we know where we stand on the rate cycle. It's probably flattish to down. I think it's more timing of when it's going to come down and how quickly. We're also seeing nice improved opportunities. It's becoming a buyer's market. We're seeing, I wouldn't call it distressed assets or distressed sales. We are seeing buyers, or at least sellers, be more realistic to sell assets at more realistic pricing. It's more your closed and open-ended funds that come to terms with the current environment, and we're seeing very, very good quality assets. The kind of assets we like with your Primarks and your full Inditex brands, dominant assets in large growing catchments. We're seeing pricing 7.5 to 8.5% on a yield basis. These are assets that probably were about 5 to say 6% in say pre-COVID 2018, there or thereabout. And yeah, I mean, in that same era, if we were buying assets at sort of that 7.5 to 8.5% level, they would be very poor quality. So it is encouraging from that side. It is putting us out there. We are looking for new opportunities. We're looking to grow the portfolio, and I think we will see some nice acquisitions coming through in the following months. I think operationally, footfalls have grown nicely on last year. I'll just give you the overall portfolio metrics, and every property is different. We're sitting at about 7.5 year-to-date growth of footfalls. Sales sitting at around 11.7%. So even with high inflation, we're still getting sales substantially above the high inflation levels. And then on the letting side, it's been quite encouraging. We've seen very strong letting, very strong demand for the portfolio. I'll maybe take you through some of the key ones. Not all of them. We have put out a pre-close announcement, and I think we've given a lot of detail on the letting progress and activity that we've been busy with over the last 3 to 4 months. But in Iberia, at Torre Dennis, it's been quite a big addition there. It's Alvaro Moreno. This is right next to Primark. We're consolidating a few smaller units that were underperforming. It's a dominant offering. It's a Spanish regional fashion retailer. It's on the value end, so it has got quite a strong following in the Spanish market. We've also added Mayoral and Parfois to that centre. And yeah, this has been a very good centre. It's outperformed since acquisition. We bought it at the beginning of last year. It continuously surprises us. It's the Inditex brands, they are really shooting the lights out. Their turnovers are up 30+%. It's giving us a lot of additional income, a lot more than what we'd actually even forecast when we acquired that centre. So it's been a strong acquisition and has performed well. In France, we've, I think, quite exciting news on Friday. I attended the opening of our new Primark unit at Saint-Sever. it's been a long road to get there. It took us around 2 years to develop. We started it immediately as we took transfer. It was converting a theatre complex into a Primark unit, a very complex project, dealing with old buildings, existing but very old buildings that were built in the 70s, putting it together to create a 7,000 square meter Primark unit. Yeah, having attended last week, it was absolute mayhem. The training was way ahead of what they projected. Massive footfalls, massive crowds. We'll probably share some photos with you in the upcoming results presentation. But yeah, I think it's going to be a great addition to that. Well, it is a great addition to the mall. I think it is going to shift the landscape of the retail environment in the city of Rouen. It's adding a lot more mass on that side of the river. Off the back of that, we've seen huge demand from other tenants. We've got Bershka, who've agreed they're going to occupy the space next to Primark. They'll take occupation early next year and should open, I think it's May or April in 2024. And then, yeah, the demand from other tenants off the back of Primark, Foot Locker wanting to, they're already in the mall, but they want to triple their size to a much bigger sort of concept. I'm also happy to go on the upper level because now Primark's there. You've got Normal, Action, as you know, opened last year. And it's going to start competing quite strongly with the high street. Rouen is a city with a strong inner city retail offering. It's got a weakness though. It does have only small boxes and small units, so it is more difficult for the larger tenants to find space. And we're offering them bigger units and bigger space in Rouen. So we are seeing nice demand there. Dock 76 is the other centre in Rouen. We carefully trying to manage the situation, owning both centres. Sanseville is the dominant one. But we still trying to keep Dock 76 relevant. We are putting the right tenants in. We are going towards more convenience, a bit of value, and then some more exclusive brands like Bultoki, and we've signed an agreement with Snipes, and we will be filling up that centre slowly and trying to complement each other. And these are the only two shopping centres in the city of Rouen. And this is the offering that we'll provide to the market. I think other news in Planet Copa, we've agreed terms. We've signed a lease with Decathlon. I'm sure you all know Decathlon. They are present in South Africa. It's not very often you get them in your malls, so it's a very, very exciting prospect for Copa to get a 3,000 square meter Decathlon unit into that shopping centre. It will make it quite a regional offering. It already is the dominant centre, but it further strengthens its position. And then I think on the letting side and the activity side, as I said, there's a lot more information in the SENS announcement. On the other side, on the transaction side, you would have seen we announced we have entered into exclusivity for an acquisition in Spain. We do like the Spanish market. It's a good operating environment for landlords, as well as the retailers. They're performing very well there. We in the due diligence process, we're anticipating to close out in February and take transfer in February next year. We're funding this by Hammerson disposals. We've already accumulated sufficient cash to make the acquisition. We sold 200 million Hammerson shares. We are now sitting on around 62 million of cash that will be redeployed into this acquisition. You would have seen our gearing is currently 15%. It's reduced quite substantially. It's because of the sales, but it will bump back up to around the 24% level once we take transfer of this asset. We are also looking at additional acquisitions. We are busy in Spain. We are in talks on another asset. We hopefully will have an announcement for you in the next week or so. And further add to our physical portfolio. I think the strategy for Lighthouse is a property company. We're looking for only very good quality assets that meet that profile. We're looking for malls with the Primarks, malls with your Inditex offering, malls that are dominant in their catchment areas. So I think we'll open up the floor then. I think you've probably got some questions, Ridwan, and maybe if anyone else has some questions.
Perfect. Yeah, so we'll start with the two exciting developments, selling Hammerson, looking to buy property assets. So questions around the disposal of Hammerson. You know, what do we take from these announcements? You know, is Hammerson now considered non-core? Do you look to reduce it to 0%? You know, or are you still happy with around 15% shareholding? You know, just some information on your disposals.
Yeah, I mean, Hammerson has been a good investment to us. It has done well. It's probably reaching end of life in our world. But for us to be considered a sale, I would say three things need to happen. We need to have an opportunity identified, and they're not abundant. We do need to see good liquidity in the market, and we also do need to see quite a strong share price. Unless all three of those variables are not in play, we probably wouldn't be considered sellers. Yeah, I mean, I was with the team in Dublin last week. We went to go see the assets. They had an analyst tour. They're doing the right things. They are making good progress on reducing the admin costs. They are starting to make those wholesale changes that needed to be done, not just trimming of costs here and there. I think we'll see a lot more kind of uplift in earnings from just constant expense reductions. As I said, these are wholesale changes. I'm not sure if they fully known by the market, but it's changes that will move the needle in quite a meaningful way, or we believe in, which will be quite a meaningful way. Also, the disposal programs are going quite well. They've disposed of the developments, so they are making a lot of good progress. I think Des also mentioned it in his call. I mean, we're very disappointed with the payout ratio. We've made it known to them. We think 65%, especially when they find themselves in the situation they are, quite abundant cash on their balance sheet, to now be holding back 60, or at least paying out 65% of your income. It makes it, for us at least, it makes it quite a cheap source of capital in a way. It's a 5% yield net of withholding tax in our lives. So it does put us in a position, if we rotate into assets like the one we're looking at, you'll be close to a 10% sort of cash on cash yield. This is after the debt. So it's very accretive from that perspective. If we are able to rotate at 5 and reinvest, that's at 9 to 10% on a cash on cash basis.
Okay. And then, you know, talking about acquisitions, and then maybe just from a gearing perspective, you know, your LTV is going to come down post the disposals, but then increase after the first acquisition. You alluded to a potential for a second acquisition. You know, will that be funded from further Hammerson's disposal, or look to increase debt? So maybe just try to give a picture on the gearing levels that you're comfortable with.
Yeah, we've got a lot of runway with our gearing sitting at, let's say, post-transaction of 24%. So I think we're quite comfortable to go up to the 35% level. So whether through additional debt or through Hammerson disposals, whatever one is most appropriate, we would use that to fund a subsequent acquisition.
Perfect. And then the acquisitions or potential acquisitions that you guys looking and opportunities you're seeing, you mostly so far around Spain. Are you seeing opportunities in France? You know, given Resilience call preferring France, given the access to the bond market. Is that you know, if you just give us maybe some color onto the property landscape and opportunities you're seeing within Europe.
Yeah, I mean, we do like France. The portfolio we have in France is different to what we have in Iberia. Iberia is extremely core blue chip assets. I think a lot of you have visited. I know you have visited Coimbra. You've seen Torre Cadenas. These are solid assets, and not much needs to be done to them. The assets we'll add will be probably similar. So we have got a nice core portfolio in Iberia. France is value add. That's where, and on the other side of that, we will see a lot of our upside coming from there. It's very hands-on. It's taking a lot of our time, and it does take a lot of our effort. So I think maybe from a capacity perspective, we probably will hold off in France for a while, deliver what we need to on the assets we're working with in France, and then I think for now our preferred market will be Iberia. We like Portugal and we like Spain.
Yeah, and then the next question was around capacity. So, you just alluded to now that, France, given capacity, you're taking on potentially 2 additional acquisitions. Um, from the size of Lighthouse, you're comfortable with the current team, or do you think that there might be need to bulk up given the 2 potential acquisitions that you could come on board?
Yeah, it's our existing team. Maybe to shed additional light, we've entered into quite a nice sort of partnership type relationship with Multi. I don't know if you guys are familiar with them, but they're one of the major European property managers. It's owner run. That we've been with them for since we acquired Coimbra in 2017. We've now gone uh, on a sort of exclusive basis with them. They've now taken over the French portfolio. They've also taken over our one asset in Spain, and they have always been running from Coimbra. And it's a big machine. They've got lots of finance resources. They've got development skills. They've got in-house property management skills. So if need be, if need be, we would tap into that, and we do. It has given us nice capacity, but I think as far as Lighthouse's direct team is concerned, I think we have got capacity for at least 3 more assets before we would need to start bulking up on that front. We have added to our team over the last 12 to 18 months for France, and it also not only for France, also to give us capacity to look further into Iberia.
And the size of acquisitions that are coming on board, given your LTV expectations, the deals are looking around 70 million euros. So not the size of a Torre Cadenas, but are you seeing, if you're looking at the opportunities that are coming through, is it between the 50, 100 million euro mark, or are you seeing anything above 100?
I
And the
think
yields that you're seeing, yeah.
Yeah, I think just maybe I don't know if it's clear, but the 70 would be the equity price of that acquisition. There's debt embedded in that structure. So the gross asset value is north of 100. I think most of the assets we're looking at now are around that 150 million level. The types of assets we like, I think as soon as you cross over to a level where you want Primark and you want Inditex, you want a nice grocer, you want the dominant center. These are centers that are inherently going to be bigger, and I think they're going to fetch a price of at least 100, on average closer to 150, I'd say.
Okay. And then a question from Nazim on the deal. Can you provide more detail on the debt within the potential Spanish acquisition, LTV, term, and cost, and if there are any fixes?
Yeah, so we are under exclusivity and confidentiality on the agreement, so I probably can't tell you much. I can. It's going to be around 50% geared. Yeah, I think maybe just to be careful, we don't want to say what we can't. So maybe the terms of that agreement I can't share with you at this point in time.
Perfect. And then, if you can, is it possible to talk about the equity yield on acquisition, or at least a bracket that you guys looking at? You
I think
mentioned the yield earlier.
everything we do now, if it's got debt in, it's going to be between 9 and 10% on an equity yield basis.
Okay. And then you mentioned an increase in opportunities. What is driving this?
I think just people have been holding out at least these. I mean, no one's ever, well, at least the quality assets that we like. I mean, they normally quite strong hands. It's big funds, it's REITs, it's pension funds, that kind of company. These are companies that haven't really gone under massive amounts of distress. Maybe to some extent the REITs have, but they tend to sell their tail, so you don't really get quality assets out of a distressed REIT. But I think these guys have now just run the course too long. They've held out for too long, and now sort of coming to terms with the new reality of these higher pricing.
And then a question from Meyer. Can you provide any further granularity on the NOI outlook for the French portfolio for FY23 and going forward, just relative to previous guidance?
Yeah, so for 23, I mean, we did sort of update the guidance at the last results announcement for H1. I think that will remain. We haven't yet given guidance, and we're not going to give guidance yet for 2024. I mean, I think all I can say is next year will be a good year for France. The budgets are looking good. There's been a lot of voids and vacancies, and that's all being filled. A lot of it has already been filled, but you don't see the benefits when you fill the box in November or December. You only see it in the following year. So next year will be a strong year for France. I think we will see some nice upside, but in terms of guidance, we'll give guidance at the full year results presentation.
And then just a follow-up question from Nazim. On these opportunities, do you believe that they've underspent on these assets? And is there a risk of CapEx spend needed on these opportunities?
These new opportunities, they vary. They're quite blue chip. I mean, and if there is CapEx, it's catered for upfront. It's identified and priced in. So even if we disclose a yield, it will be post the required CapEx on the center.
And then this comes back to the operating metrics or the portfolio. I don't think a vacancy for the French portfolio was disclosed. You are seeing let-ups at Saint-Sever, Rivertois. Just what's the vacancy sitting at or predicted to sit at December?
For France, currently we are at 9.5%, and this is without taking into consideration the heads of terms that are signed in some of the leases that we expect to sign by the end of the year. So we were very confident that all these heads of terms will turn into lease agreements, and what we expect in the next 1-2 months is to be at around slightly over 7%, so about 6.9%. This is France.
Yeah, so that's where we're expecting to land at year end, is just below that 7% level.
And predominantly, I would assume the vacancies would still be at Saint-Sever and Rivertois, or is it going to move to Dock 76? Which assets, which vacancies? I mean, which assets will the vacancies be sitting at if it's at 6.9? Just trying to get see the uplift from bringing in Primark.
Yeah, some of it still sounds fair. There's still quite a sizable one. You'll recall it was a GoSport box. It was a big unit. GoSport went into receivership and they went into liquidation. We've received that unit back now, and it's quite lettable. I mean, with Primark there's good demand. We negotiating with a sports retailer, another sports retailer. It's still early days, or at least on that specific negotiation. So having looked at the number that Razvan just showed you, it's not included in there. But again, with Primark there, I'm very comfortable. We will let that unit. It's a big box in the mall that's got Primark, and these are quite rare commodities. So I think end of this year, end of next year at least, that will be completely let. I would say Saint-Sever end of next year probably be close to fully occupied, maybe 1 or 2% vacant.
Yeah, so we have the heads of terms signed with Bershka. This is almost 1,000 square meters. Chaussea, it's a shoe retailer, market leader in France. This is 1,200. And then with Normal, this is a very popular health and beauty retailer. This is 500 square meters. We're increasing the size of Foot Locker. All of these ones are in Saint-Sever. Everything here it has a term signed, so we expect them to turn into lease agreements. And then, as Justin mentioned, for the unit of GoSport, which is close to 2,000 square meters, we have some advanced negotiations. So that GoSport box, it's not included in the 6.9 that I was mentioning.
And then can you give some indication of what you guys are expecting around indexation in the different geographies that you're operating in?
Yeah, for next year, indexation will be, it depends on the country, but it will be between 3 to 3.5.
And then we have some questions coming through from Evan. You allude to acquisitions at 9 to 10%. Does that put pressure on your current valuations? And then where do you think your cap rates settle on the French Iberian assets you already own?
Okay, so the 9 to 10% will be an equity yield, so it's not what the valuers would be using to value an asset. The range we're looking to, if you want to look at property yield, is 7.5 to 8.5%. because of gearing, and the impact's less extreme as it used to be when we had 0% base rates. But because of gearing, that's 7 to call it 8.5 bumps up to between 9 and 10%. So we're looking at assets between 7.5 and 8.5%. In terms of valuations, we are getting, I mean, there's a lot of tailwind from inflation and from these escalations that we're seeing. So we are seeing incomes going up quite nicely. And then on the other side of the equation, we do see cap rates also lifting. So I think valuation is probably going to be more or less flat. I haven't seen all of our valuations yet, so I can't give concrete guidance on that. But I think management's view is that it will be more or less flat for year end. Income up, cap rates, income up and cap rates also slightly up.
Perfect. And then the second question, are you buying dry assets or assets that provide turnaround opportunities?
Yeah.
Or
So
what would you be looking to buy?
So we always want to see something that's, I wouldn't call it a turnaround opportunity, but there's quite certain upside when you view these assets. You see a more like a Toraka Dennis. I mean, and I'm glad you've been there, because that's by no means a dry asset, but it's not a turnaround asset either. There was a consolidation benefit that needed to be fetched by the mall. It was the new mall in town. The retailers still needed to close. Zara needed to close. Other retailers that had 2 or 3 offerings in the city needed to close and consolidate into the centre, and it's been happening and driving the growth there. So I think it's neither. It's more a case of where we see consolidation and where the consolidation will go to. Those are the assets we're targeting.
And then coming back to the French portfolio, you're seeing footfall up 13%, sales up 10%. Is that performance across all 4 assets, or some assets performing better than others? Just trying to see what's driving that sales and footfall numbers.
I mean, it's different at every asset. Saint-Sever, for example, quite badly down because of the construction that's been underway there year to date. Primark's there, so I can tell you next year you'll probably see a footfall growth there of 15-20% plus, because we anticipate Primark will bring another 1 million feet to that centre. So yeah, that one's down. Doxville Barn, I think, as you know, they've been undergoing a infrastructure upgrade project. In the half, it's now completed. So again, that one will be up. The big drivers have been on footfalls, at least Dock 76. We added Waltoki there. We added Akshan. We've seen footfalls react quite nicely to that. And yeah, it swings and roundabouts. I think that's the average, the weighted average. I think next year will be another strong year, but I think because of specifically the infrastructure upgrade at Doxville Barn and now Primark having into Saint-Sever. And then the new lettings that Razvan's currently busy with in the balance of the French portfolios. I think it will just, these things constantly drive additional feet every time you add these new sort of blue chip tenants to your malls.
What Justin is just mentioning is footfalls, but sales, we see increase in all the assets, including in France. So France is, the malls in France are between 7.1 and 12.5% increase in terms of sales. So footfall is lacking in Saint-Sever and Doxville Barn for the reasons mentioned by Justin, but sales are up in Saint-Sever 12.6%, Doxville Barn also 10%.
Good. I was excited about Waltoki. Is that performing the way you guys liked it? Is it pulling the feet that we thought it would pull? How's the reception to it?
Yes, it's the performance is I think it's better than expected, and it's bringing Dock 76. It's consolidating on this leisure and restaurant side. We are very strong. We have some very good performance from our restaurants, and we are now improving the convenience part with the opening of Action. But this was they opened 2 weeks ago. They had a very good opening. We also have Action in Saint-Sever. Saint-Sever is it's a top store for them. Action has 800 stores in France. Saint-Sever was performing very well. And for the first 2 weeks, there was no cannibalization, and Dock 76, it's at the same level with Saint-Sever. So it's very good on this side.
And then can you talk to the admin process or tenant failures and the proceedings to recycle the tenants? Initially you gave an anticipated impact of around 720,000 euros. How's that evolving? Is it still uh, according to what you guys were expecting, or is there any decline in that number?
I think they're progressing well. We've received a lot of the keys back. We've already let a lot of the boxes. Maybe some of the big ones. We mentioned Go Sport. We've received the keys back. We it's important that we get the right tenant in the box. So we are busy with kind of selecting that tenant. Another one actually, and the situation is different depending on what ends up happening with the tenant. But another one that failed was the Grand Decret. Big toy store operator in France. They had a national sort of delinquency. They were acquired by the competitor group. So what ended up happening there is we never got those units. Never went vacant. They were inherited by the acquirer of that company. We did have to write off all the arrears that were due by the old owner of Le Grand Decret, but the new owners operating has actually improved the stores quite nicely. They're a much stronger operator, and they've been quite consistent with paying their rents, haven't adjusted rent. So there was a bit of pain on having written off the arrears, but at least we didn't have a void. We didn't have to relet the units. So it's different. It's different case by case. I think we will be close to that number we guided to be. That's just Lighthouse's portion. So you need to gross up to get the full French impact on that guidance we previously gave.
And you got indication that they'll keep the store, the toy operator, or do you think they'll give the space back when the lease expires? Just trying to get a sense of where they are. Are they happy to be in those malls?
I think they'll keep them. That's why they bought the business. To have these spaces are quite valuable. So they're operating there. They seem to be operating fine. In France, you have a break option every 3 years. It's just standard practice for the operating environments in France. So if they wanted to give them back, they would have probably given them back by now. That's just how the rights of the tenants sit with.
Yeah, in Saint-Sever, they are right next to the newly opened New Yorker, and they also did La Grande Recré did a light refurbishment. So actually, the performance improved a lot, and that area of the mall improved a lot.
Is it safe to say that if these tenants are underperforming, the time it takes to replace them is quicker than expected? Because at half year it seemed that the process would be a long process to change tenants and get the keys back.
So I think at the beginning of the year and end of last year, beginning of this year, we faced this tenant failures. Since then, I think it's a process that the French market is going through. Probably in UK this happened a few years back, but since then the performance has improved. We don't see any new failures coming, and we see the performance improving.
Yeah, again, it's somewhat quick, surprisingly quick. Some are annoyingly long. It's just the way that they need to. It goes into sort of curatorship, and they need to then sell they go into creditor protection mode, and they then need to sell the business. So they try and sell the business. There's a lot of notice requirements in that process. Again, sometimes they sell the business and it ends up being quick. Other times it does take long. But I wouldn't say it's different to what we thought it was 6 months ago or at the last time we reported.
Okay, perfect. And then can you update us on the Repertoire redevelopment, the land purchased starting in Q4 this year? Is that still on track?
Yeah, so we have acquired the land. We're now the owners of that land. The initial process has started. That includes getting the approvals and consents from the tenants, assembling the construction teams, finalizing the permits. So that work has started. They'll probably be in ground Q1 next year.
Any pre-lets that you've managed to sign on that development?
It's a lot of it's to cater for existing tenants to expand them.
Okay.
So we're not going on pre-lets there, but it would be on existing tenants to expand them. We're still trying to finalize exactly how we do it. It may, because it's quite unique in its design. There's three completely separate components to it. There's an option to maybe do three quite staggered, take letting risk out of the, or at least reduce letting risk to quite a acceptable level. But we're looking at that. It's in consultation with the existing tenants that we're looking to expand as well.
And then coming to Coimbra, I know it performs well, but there's plans to extend or expand the Inditex brands. Has that process started, or is that a plan for next year?
Yeah, it's been a long process, but it's very much on the cards, and it's, I mean, we're not allergic to it taking long as it's in progress and it happens. Inditex are going to expand to their flagship offering. They're already trading extremely well, but I think that if they do this, they more than likely will close in the competing schemes and consolidate into the center. So I think it's very important that we do it. I don't see a risk of them leaving. If you go to the competing scheme, it's very old concepts from Inditex. They haven't invested any money there. Turnovers are quite low there. So it is happening. There's three things that do need to happen for this thing to conclude. We need to acquire a bulk. We didn't have enough rights to expand to the required surface. We've now secured the rights. We bought them from the tenant, who's not the tenant, our neighbor, who's Decathlon. We need an agreement with Zara, or at least Inditex, and we also need an agreement with Primark. We've agreed with Primark. We've secured the rights. We're finalising the agreement with Inditex. It's taking probably longer than we would like, because they are doing what they usually do and trying to bully landlords. But in this situation, we've actually got the upper hand. They need our location probably more than what we need them in our location. So we're trying to get the maximum out of that deal before we proceed with the project.
And what would the plan be if Inditex aren't willing to sign? It's unlikely, but what are the chances? Is there anybody else that's willing to take up the space?
No, we would just proceed with Primark only.
Okay.
You can quite easily do that, and just leave Inditex as they are. They wouldn't want it. Their model is to consolidate and expand to flagship offerings. And if they don't do it, like I said, we see very little risk in them not doing it. If they were not to do it, it wouldn't be of much consequence to us.
Perfect. And then the update on the road infrastructure plan, upgraded Doxelbaan, you said it's completed. How's that asset performing, or is it still a bit early to tell?
It was recently finalized, and end of October. It was finalized. Yeah, we see it's good. It looks good so far on the footfalls, but it's very early.
Perfect. And then coming to the debt, can you update us on the debt renewal of the ING consortium, about 78 million euros, and the Santander consortium for July 2025? What's your expectations there?
Kobus is hiding in one of these,
I see
these circles. Yeah, we'll call him up to answer that question.
Morning, Ridwan. Yes, we've made significant progress with the negotiations, but as of today, we haven't concluded renewal terms yet.
But the liquidity in the market is improving, I guess, and
there seems to be significant interest.
Yeah, so there's two big expiries we got. One is ING, that's from Coimbra, that expires next year, November. We've already quite well advanced in discussions with ING. There's more than enough appetite to refinance. So it's not about refinancing risk. It's just more about getting the best deal for us. So I think we're haggling a bit on pricing and terms. The loan we have got in Spain this is with a consortium of Caixa and Santander Bank. We've agreed terms. I think we'll probably look to conclude that early next year.
Right.
But we're seeing for quality assets, we're not seeing an issue with refinancing with bank appetite.
Yeah, that's the next question I wanted to ask is, can you give us insight into the liquidity in the European debt market? Is it more skewed to the bond market? Are the banks having appetite, like you said, for good assets? Is it, depending on what asset it is? Just can you give us some insight into that, please?
Yeah, so retail is now no longer the ugly duckling of the property sector. It's kind of been crash tested in a way. It's been through a lot. It's been through e-commerce, it's been through COVID. It's come out on the other side quite strong. We're seeing and this only pertains to strong centres. The strong centres are, I think, for the most part, with NORs far above where they were in 2019, that delivered inflation even through the cycle. And the banks have realised this, and they've become quite happy to finance these assets. Maybe I'll just caveat that they are still conservative with gearing. We go in with sort of 40 to 45% leverage. It's very low in the markets. It's lower than what most people would typically finance. They normally used to seeing 50-55%. So I think that's also part of their willingness to at least fund our projects, not needing so much debt on an asset by asset basis. So I think with the good quality assets, with a good track record, they're happy to refinance it. We don't see any substantial risk in refinancing newer assets.
So then, is it across geographies, or is it specific only to, let's say, Spain, France, or are you seeing similar liquidity in Portugal, for example?
Yeah, Portugal's plugged into Spain quite quite a bit, because I mean, even ING we deal with it's a Spain office. There are Portuguese domestic banks. We haven't engaged with them on this, but we have looked at other transactions in Portugal before, and we have engaged with other banks in Portugal before, and same thing. There was appetite there from the Portuguese banks, but in Portugal you can quite easily get pool funding out of Spain.
And the margins that you guys seeing, is it similar to pre-COVID? Can you just talk to the margins? Is it higher?
No, I would say pre-COVID we were funding at 2 to 2.5, and now it's 2.5 to 3. There's been a 50 pip shift in margins.
And then the gearing on an asset, you talk to 50-55%. So above 60%, I'm guessing you're not going to be able to get funding on the property from a bank.
So we would fund at 40 to 45.
Yeah.
If you push up funding, you may get it up to 55, but as soon as you go over that, if you're lucky, because you're going to start running out of appetite by the time you get there. But if you even do go over that, it becomes sort of mezz funding, and it becomes very expensive.
And then on the bond market, is there appetite for let's say non-investment grade property companies? If you guys look to tap that or not yet?
I think if you're non-investment grade, I don't think you want to be in the bond markets. I think it would be I don't think it would be a wise move to issue a non-investment grade bond, especially a sizable one. So I think that's all we get to. I mean, we will, that will be the next step, and this does talk to the French assets, the quality of the portfolio we're building. We want to hit sort of a billion or close to €1 billion of physical assets under management. So a lot of it is our Hammerson shares at the moment. So once we get there, I think the bond market opens to us. I think we will get an investment grade rating if we keep our leverage low, and then I think we will be seeing attractive terms in the bond market. But as it stands now, I think bank funding is probably preferable. You can negotiate. I mean, they're a bit more flexible. Bond funding is very rigid. If there's they've got, when that loan matures and it's a bond, you get sequestrated. You don't just sit around the table with the bank and get a year extension. So it is risky to go with bond funding. For now, we're happy to have smaller pockets of funding with banks, and then in the long term, we would like to enter the bond market. And again, once we've got our investment grade credit rating.
Perfect. Some questions from Nazim. Questions on the accretive recycling activity. Do you anticipate to do enough deals to keep dividends flat year on year?
I would hope so. We haven't. I mean, it's hard to peg a probability on deals. We've got one that's under exclusivity and under due diligence. I'd say that's highly probable. But outside of that, I mean, if we do 3 acquisitions, we probably will be close to being flat. But we would still need to get there. And again, now it's getting to a point. If we were to even find an acquisition now, one other acquisition probably only close later in the year, and the impact becomes diluted because you're only collecting the benefit on 8 or 6 months of the year. So it's maybe getting a bit late to get the full benefit of 3 full acquisitions. As it stands now, we should close one in Feb. We will get most of it next year. It will be accretive. The one we in discussions with also closed early next year. if we secure it, would be accretive. And then the third one would probably be later in the year. Then by then it's probably a little bit late to get the full benefit of it, but it will then come through in 2025.
Yeah. And then can you confirm the payout policy post FY23? Will divis match earnings going forward, or do you intend to adopt a payout ratio?
I think our intention has always been to match divis with earnings on a sustainable basis. We have been through Hammerson, and we've been through the enhanced scrip dividend and them not paying any dividends, and we've been through that whole process and kept retained earnings. But we would like to move away from that. We would like to just pay a regular cash back sustainable dividend going forward.
Perfect. And then on the tax that's expected for this year, is there any change to what has been initially guided to? Cobus?
Yes, we've been working on our Portuguese REIT equivalent regime for some time, and we're confident that we would be able to implement that in the foreseeable future.
Perfect. And then maybe for Razwan, are you seeing any structural change to the tenant mix which you would like to capitalize on? Meaning, are you seeing more exposure, or you need more exposure to groceries, at leisure, entertainment? How are you seeing those evolve in the markets that you're playing?
What I see, it's a very good performance coming from specialized value retailers. I will mention Action and Normal. Both of them are the growth that we see. The performance is very strong, and we have one Normal in our portfolio. It's growing more than 30% year on year. Action is performing very well. So we see very strong performance from value retailers and specialized. Action is non-food, and they draw traffic in some of these locations that usually are not taken by other tenants, and they're very happy to be there because they know that they are destinations. So yeah, I think it's we see these value retailers doing very strong and being very attractive. The polarization continues on the fashion side. We see Inditex closing the smaller stores, but this is mostly high street stores, because those are actually the small stores, and they are consolidating into malls. So that continues. We see especially Zara, they are closing some of the small stores, but mostly in the city centers.
And then maybe just the last question from me regarding your guidance update, 2.07 euro cents for FY23. Maybe just talk to that, and then the retained earnings that that's used to get to that number.
Yeah, so that remains intact. We're not changing that. And yeah, we will be using retained earnings to get to that level. I think as per the original intention, it will be vast majority of the retained earnings. There'll be a couple million probably that'll be rolled over. But as I said, we don't want to be using retained earnings or using that concept going forward. We move away from that. Yeah, so I don't know if that answers your question.
No, it does. Let's give it a few seconds for any final questions to come through. If not, then we can end. Okay, seems we don't have any further questions. So can bring the call to a close. I'd just like to thank Lighthouse for letting Nedbank host the call. Thank you to everyone for joining, and have a great day further.
Thank you so much.
Thank you, Ridwan.
Thank you so much, Ridwan, and everyone that attended. Hope you have a good Christmas, good holiday, and we'll see you probably in March for our final results presentation.
Perfect. Thanks, guys.
Yep.